There's a rule on Wall Street that most people never really get. The pros? They don't panic out loud. No way. When they see real trouble coming, they don't blast it on TV or send out mass emails. They just move. Quietly, systematically. They start repositioning their massive portfolios long before the rest of us even have a clue what's going on. And well, right now in April of 2026, one of those quiet, systematic shifts is happening. The biggest money managers in the world are getting ready for an economic storm that they believe isn't some far-off possibility anymore. Nope, it's now their base case. The proof is kind of hiding in plain sight, and in this explainer, we are going to follow the money. I mean, just take a look at the first quarter of this year. It's a tale of two completely different markets. On one side, you've got the big stock indexes, the S&P, the Nasdaq, the Russell 2000, all down and down big. But on the other side, whoa, oil prices have just exploded by a staggering 73%, and gold is holding its ground. Now, this is not random. This is a huge signal, a major divergence telling us exactly where the smart money thinks we're headed. So it just makes you ask the obvious question, right? What is behind this massive rotation? What are the big institutions seeing on the horizon that maybe the rest of us are missing? The answer, it turns out, is a single, deeply feared word from our economic past. They're getting ready for stagflation. And it is so important to understand why this isn't just your garden variety recession or a simple bout of high inflation. It's a toxic mix of the absolute worst of both worlds, and it creates a total nightmare scenario for your typical investment portfolio. So, what is it? Stagflation is basically a 1-2-3 punch. You get a stagnating economy, which means little to no growth. You combine that with stubbornly high inflation, and then you add rising unemployment on top. Now, what's really wild is that if you look at the old economic textbooks, this wasn't even supposed to be possible. You were supposed to get either growth and inflation or no growth and no inflation. Stagflation just breaks all the rules. And this right here perfectly illustrates why it is so dangerous. It completely paralyzes policymakers, like the Federal Reserve. Think about it. If they raise interest rates to fight off inflation, they risk absolutely killing whatever little economic growth we have left. But if they cut rates to try and juice the economy, they risk sending inflation to the moon. There are no good choices. They are completely and utterly trapped. Now, this might feel brand new and scary, but it's not. The institutions that are moving their money today, they are working from a very old, very well-defined playbook. Because, as they say, while history doesn't repeat itself, it sure does rhyme. Just look at the major stagflationary periods from the last century. You had 1973 with the OPEC oil embargo, then 1979 with the Iranian Revolution, and even a shorter shock in 1990 with the Gulf War. Are you seeing the pattern here? Every single one was kicked off by a sudden, geopolitically driven shock to the world's energy supply, a supply shock. And the playbook from that time is crystal clear. During the stagflation of the 1970s, traditional assets got absolutely hammered. The S&P 500 lost almost half of its value from top to bottom. Bonds, they gave you negative returns once you factored in inflation. But the winners? Oh, the winners were energy stocks, commodities, and gold. They didn't just hang on, they soared. This is the exact pattern the big money is following today. Okay, so let's fast forward to right now and see how this all connects. Because what happened in February and March of this year, well, it looks eerily similar to those historical triggers. So on February 28th, joint U.S. and Israeli airstrikes hit Iran, and the retaliation was incredibly swift. Iran essentially shut down the Strait of Hormuz, which is a critical choke point for all global oil. Overnight, just like that, a full 20% of the world's daily oil supply was yanked off the market. The International Energy Agency literally called it the single largest supply disruption in history. The market's reaction? It was immediate and it was violent. Brent crude, which is the global oil benchmark, rocketed up from the $60 and $70 range to touch $120 a barrel in March. And the economic fallout, it followed right behind. Look at this. In early March, the Atlanta Fed's model was predicting a pretty healthy 3% GDP growth for the quarter. But by April 2nd, that forecast had been chopped nearly in half, down to just 1.6%. The stagnation part of stagflation was officially arriving. And at the exact same time, the inflation part was exploding. The OECD, which is one of the world's top economic bodies, revised its U.S. inflation forecast for 2026 to a shocking 4.2%. That's more than double the Fed's target. Slower growth, faster inflation. It is the textbook definition right there. So all the data is pointing in one direction. But what are the major institutions, the ones actually moving trillions of dollars, what are they saying and doing about all this?
Well, they are not mincing words. Bank of America, one of the biggest banks on the planet, came right out and said it. Their base case, their most likely scenario for the economy is now mild stagflation. The S word is officially out in the open.
Goldman Sachs is already modeling out the risk. They sent a note to their clients warning them that if oil stays above $150 a barrel, the S&P 500 could drop all the way to 5,400. Folks, that's a bear market, a drop of over 20% from the highs we saw in January. This is the kind of warning that makes institutions move their money. And this right here is the absolute key. This is from State Street's head of research. The pros do not wait for the government to get on TV and officially declare that we're in a period of stagflation. Why? Because by the time that happens, it's too late. The safe assets have already soared, and the risky ones have already tanked. They move on probabilities, on pattern recognition, not on data that's already old news. And you can literally see them moving right here on this chart. This is the year-to-date performance for all the S&P 500 sectors, and it tells the whole story. There is only one sector that's solidly in the green: energy. Every other part of the market is either flat or down. The money is flowing exactly where that 1970s playbook says it should be going. Okay, now you're going to hear arguments against this idea, for sure. They'll often come from people who were super bullish just a couple of months ago. So let's just quickly tackle the three most common arguments you're probably going to run into. First, they'll say, oh, it's just a temporary shock. The problem is, this shock landed on an economy where inflation was already running way too hot. Second, they'll point to a strong jobs report. But here's the thing, labor data is the ultimate lagging indicator. Layoffs happen months after a shock hits, not before. And third, they'll say, don't worry, the Fed will fix it. But the Fed's tools, like raising interest rates, are designed to manage demand. They can't drill for more oil or reopen shipping lanes. They just can't fix a supply crisis. So let's just put all the pieces together. You have Bank of America calling it stagflation. The OECD sees inflation over 4%. GDP forecasts have been slashed. Energy is the only winning sector in the market. The bond market is now pricing in 0 rate cuts from the Fed this year. And Goldman Sachs has laid out a totally credible bear case for stocks to fall much further. The weight of the evidence is it's overwhelming. It's all pointing in one direction. The bottom line is this. This smart money is not waiting around. They've seen this movie before, they know the script, and they have already acted. They have rotated out of the growth-sensitive stocks that get crushed in this kind of environment, and they've moved into the real assets that are built to survive it. They did it quietly in those first few weeks after February 28th, before it became a front-page story. And that leaves all of us with one final, very important question. The institutions have already repositioned. Now that you've seen their playbook, what are you going to do?